Hi, welcome back. In the last section, we talked about how we think about crypto investments, our core strategy, and 2 out of the 7 tenets of our evaluation framework, the market opportunity and the technology. In this section, we'll go through the remaining 5 tenets of our evaluation framework, how we grade projects, and how we pick out the winners. We'll start with the third tenet of our evaluation framework, the ecosystem. Ilya, can you tell us how we go about evaluating a project's ecosystem?
Right, so the ecosystem is the second part of the how. How does the project deliver on its goals and promises? The blockchain project is not just an R&D exercise, right? We're looking for commercial viability, commercial success down the line. Besides good tech, you need an actual go-to-market strategy, you need execution and delivery in the market space. So we're looking for the elements that will ensure that, execution and delivery on a commercial level down the line. And this is where the ecosystem lead comes in. We'll look at the ecosystem on 2 levels. On the micro level, we'll look at the base layer, the infrastructure components, like nodes, validators, every actor that interacts on a transaction level within the ecosystem. And from that, we're looking at, does the architecture support the incentive models? Does it support decentralization? It will be vital to attracting and maintaining users. Because the users are your demand. This is what you really need. From a macro level, we're looking at all of the supporting actors, right? So the foundation, the partners, the investors, if this is a platform play, all of the developers that are working on dApps within the ecosystem, right? Because again, this is all about, building networking effects, right? If you're a platform play, you need as many developers and users to come to your platform in order for you to sort of establish those networking effects and become a legitimate player. So we're looking at that from a qualitative and a quantitative perspective. From a qualitative perspective, we gather data, a lot of it by speaking to the teams, speaking to subject matter experts, speaking to teams building on the platform. From a quantitative perspective, we try to gather as much data that involves transaction statistics, social media data. We'll look at wallets and movements between wallets. We'll look at the centralization structure or decentralization structure of it, and we try to establish whether the numbers support the story and the thesis and the goals that the project has. We're really looking for a structure in which we can see that the project will grow and develop. Is there enough money allocated to marketing? Is there, a supporting structure for, projects to build around the ecosystem? Is there a plan to attract users? Is there a plan to attract developers? We're looking for, a project that has a go-to-market strategy, that has all of the tools necessary to deliver on that strategy so that we can see commercial viability in the medium and long term, because that will drive demand, and that will, affect, at the end of the day, the value of the underlying asset.
Once we understand the what and the how, the next question is the who. This is the team analysis. We need to assess if this is the right team to execute on the vision. At the end of the day, these are all classical IT startups, and everything points towards the team. We ask ourselves questions like, do they have the right leadership to steer the vision and adapt to changes? Do they have the ability to recruit the necessary resources and talent needed to execute on the roadmap? We're looking for people with connections and know how to leverage these connections. And if they failed in the past, is it the case that the person has tried and learned something from it, or are they doing the same thing again? And are they looking for a get-rich-quick scheme? First, we want to get an idea of the team's overall level of technology experience and their level of experience building blockchain projects. Blockchain is still a relatively new technology, so we don't expect people to have 10 years of blockchain experience, but their technical lead should have at least 5 or 7 years of relevant experience building and architecting scalable technologies and platforms. And they should have at least 2 years of blockchain experience. Outside of pure technical experience, it's important for the team to have a proven track record of domain space knowledge. If the project is tackling a specific vertical, then they will need the expertise and knowledge to really understand how the industry works and be able to navigate through these unforeseen challenges. We also want to see strong team cohesion within the leadership. One of the biggest sources of failure for most startups come from team members not being able to work together or have different visions. Forks of teams where teams split up can be extremely dangerous. Internal debates are healthy and give rise to new ideas to help teams flush out bad ones. But too much infighting in the early stages can lead to team members splitting up and major deviations in the vision. It also leads to a lack of productivity. We also want to find out about the team members' go-to-market experience. Building a product is just the beginning of the battle. Bringing the product to market and getting users and adoption and achieving product market fit is a whole other challenge. So do they have the personnel that knows how to get awareness? And of course, we need to assess the ethical qualities of the team members' characters. Does anyone have a history of being involved in scams or questionable businesses? Tokens give virtually zero equity rights to investors, so we are trusting the core team to deliver the project with no recourse. We can talk to the investors from previous companies and ask them what they think. If team members have burned investors in the past, chances are they will do it again. We talk to the team members and assess how they respond to these questions. We want to see how open they are to their past. Do they have something to brag about? Are they ashamed about something? Are they trying to dodge questions? Sometimes it's not what they say, but how they say it, and most importantly, what they don't say. So that about sums it up for the team. Next, we'll go to Andre to explain how we evaluate the token economics.
When designing the token, there's two primary schools of thought that's normally used in terms of what you want the outcome to be and what is the most beneficial value for that. The first is by taking the product design into consideration. So in this circumstance, let's take a proof of work blockchain as an example. The consumer is the person that wants to send the transactions, and they want the security that these transactions are going to be confirmed and safe. They're willing to pay, let's say, 1 token. Now for the consumer, they want this token to be as cheap as possible so that they maximize the value out of the service they're using. If it's too expensive, they're not going to use it. On the miner side, in this case, or producer or validator, depending on your terminology, they want it to be more, the token's value to be more than their base expenses so that they are making profit. If it is far below that, they're not going to be willing to provide the service. So you have this band of consumer lower bound and producer upper bound, and a equilibrium token needs to live between these two bands for the system to successfully operate and work. On the other side, and the other design mentality that we often see in the space, is purely on the speculatory side. This is on the investment side. So ignoring the product, we'll come back to that in a bit. If we just look at the speculatory side, now things like circulating supply become very important. A small circulating supply is a lot easier to control in terms of volume, liquidity, and even price speculation versus a large circulating supply. The other reason why circulating supply is important, especially total tokens over block rewards in a standard blockchain solution, is if we consider that it's 1 token per block reward, and there's 1 billion tokens in circulating supply. This 1 token can't affect this value. If this 1 token can't affect this value, it means it can't find this equilibrium band. So if this billion had a price point that was far above this, the consumer wouldn't be willing to pay for it, and it's never going to mediate towards that because the block rewards can't affect the ecosystem. If it was too small, again, the producers won't get value and it can't move up to them, and you sit with the same problem on the other side of the equation. The next thing we have to look at is vesting schedules for team advisors, consultants, these things. What are the cliffs? What are the fall-offs? How long will the team be interested and vested in the token? How long will it help them support the ecosystem? And what value can that bring to their solution as well? So we often see the second being given quite a lot of careful consideration while ignoring the first. So the tokens aren't designed with the system equilibrium in consideration. Now, if that happens, it means that important milestones on the product side, like the product launching or being active for a few weeks, or big milestones, can't affect the speculatory side. And when that happens, essentially you've killed your product because your design wasn't built for it. So there's a lot of careful considerations and a lot of minutia when it comes to designing the tokenomics, and what specific choices will either be able to provide a positive income in the future, or a negative, or even a net zero situation. So there's a lot we need to consider in terms of all of the choices the team made, and also by viewing this we can also see where the team's interest is. Is it on the product side, or is it purely on the speculatory side? So again, analyzing how these were designed tell us a lot about the future potential and the current team.
So far, we've explained how to evaluate the project from a few different perspectives: the market opportunity, the technology, the ecosystem, the team, and the token economics. We'll go to Ilya to explain the final two tenets of our evaluation framework: the token performance and the roadmap.
So token performance is one of the more immediate and one of the more popular parts of the framework, because people want to know about the price of the underlying asset, right? This is how investors, generate their profits. People want to know how the token is performing. However, we look at the token's performance in a more comprehensive, fundamental way. We look at things like, price, volume, volatility, but we'll look at it in the context of, again, does it support the overlying story, the overlying structure? So what do I mean by that? Let's say we're talking about a payment token, and it has really high volatility, right? Even relative to, average market volatility. So that to us means that the chances for adoption are a lot lower than, for an average token in that segment, just because, well, which merchant is going to accept a highly volatile asset like that for, coffee? Again, when we can go further, similarly, right? If we're studying markets, right? Like which trading pairs are available for this particular asset, which fiat pairs are available. If it's a payment token, we want to see fiat pairs in different regions. This is what supports a payment token growth on some level. At the same time, we want to see the story match. So if we're talking about a project that's targeting a European market, but when we look at the trading pairs, we only see in terms of fiat, Asian fiat pairs. That misalignment is a warning sign to us, saying that there's a disconnect between what the project is saying and how the market is actually responding. So that's a warning sign, and we look for these sort of warning signs when analyzing project from a token performance perspective. Beyond that, we look at the technical analysis, right? We want to see if there are any warning signs in terms of the patterns that are approaching. This is more immediate, even in terms of medium, long term, in terms of the time window. This is a more immediate impact. And we'll look if there's a good entrance or exit opportunity. We're looking for if there are any warning signs in terms of candlestick, in terms of how the project is performing, if it's susceptible to pump and dumps. Have there been any signs of potential manipulation? Because we look at price movements also in the context of news, and so we try to build that picture and see if we try to see if there are any warning signs, if the token performance is healthy, again relative to its market. Then when we look at the roadmap, we're looking for alignment. Essentially, does the roadmap support the stated goals and the stated aspirations of the project? How far away are key milestones, like the mainnet, for example, right? If we see that a mainnet is 3 years down the line, this is a very risky proposition for us because you really don't know what's going to happen 3 years down the line. So we want to see incremental improvement. We want to see tangible deliverables on the roadmap, and we want to see a good history of delivery. So there are projects with amazing teams, great aspirations, but they're late all the time. And when you expound that on, in terms of risk probabilities, 3 years down the line, we're talking about a lot of delays. And this is a fast-moving industry, so the chances that somebody, outruns this project and it becomes irrelevant are higher because of the pace at which this moves. So we're looking at transparency. We're looking for the project to really, talk to the community, update it, whether it's late or it's early, keeping pace. We want to see regular updates. We want to see transparency. We want to see that the project isn't hiding anything. And so, ultimately what we're looking for is that, there are clear stated goals that match in a realistic way what the project is trying to achieve, and that it's transparent about doing it and doing it in a timely fashion.
So after we have fully evaluated a project, then we come out with a grade. We consider anything with a B- or higher an investable project. We believe that these projects stand a chance and have the potential to outlast the majority of other coins on the market. The higher the grade, the stronger our belief that the project has a positive future. Anything that ends up with a C are teetering and can go either way. It doesn't mean that it's a garbage project, it just means that there are one or more areas where it could improve upon. It also means that we'll be watching them very closely to see if there are changes. And when we do see enough positive developments, then we upgrade them accordingly. C projects can easily be upgraded to a B- and become investable if they've made significant progress. Anything with a D is too low quality to merit a serious consideration in the near term. And F, well, it's really hard for us to give a project an F unless they are simply hopeless or just outright garbage. We don't think Fs deserve any investment dollars. Regardless of the grade, once we do cover a project, then they are on our radar and our analysts are actively following them. All the grades that we give are dynamic grades. So when things change, so do the grades. If we rely on static single impression grades, then we could miss out. And we continually evolve our evaluation process in order to adjust to changes in the market and also to address new projects where our existing evaluation framework may not fit very well. As an example, we've made some significant adjustments to our evaluation framework in November 2018, and our ROI has improved dramatically since then. So there you have it, the 7 tenets of our crypto evaluation framework. Now you understand how we think about crypto investments, you understand our core strategy, and you have our evaluation framework. By now, you probably realize that what we do takes a lot of time and resources to get the full picture and the real facts behind each project. On average, we spend about 150 hours on each investment report and rating. That's a lot of commitment to dedicate towards researching a project. You also saw just how critical it is to talk to project team members to get first-hand information on the vision and challenges that they're facing. We also emphasized how important it is to talk to external developers outside of the team who are involved in building apps and products on these platforms to detect if there's any inconsistencies that might exist. But getting a response or let alone a call or meeting from these guys is really hard because they're usually too busy to respond to each and every investor. Finally, when it comes to evaluating the technology, having the right technical experts and code reviewers on board can be really expensive. The guys that know what really works are usually already getting paid big bucks working on their own blockchain projects. Due to our brand and relationships within the crypto space, we have no issues getting on a call with project founders and top-level management. As far as technical experts go, we have a team of industry veterans giving us input on how things are going with the project from a technical perspective. More often than not, projects will give our code reviewers access to private GitHub repositories that have never even been released to the public before. This is what we do. Crypto Briefing's research team currently has over 10 full-time analysts dedicated to evaluating projects and identifying areas where information asymmetry might exist. We then share those findings with our members. Now, earlier I mentioned that I would elaborate a little bit more on how we narrow down projects to evaluate. Previously, during the bear market, we focused on larger cap projects that were more stable and have the funds and infrastructure necessary to last them through a bear market. If we want bigger gains, then we need to find coins that are much earlier stage and have lower market caps. Here, the goal would be to find the hidden gems before the rest of the market realizes the project is onto something. With over 2,000 coins on the market today, it's really impractical to comb through each one and evaluate them correctly. So what do? How do we narrow down which coins to research? How do we figure out which coins have the highest upside potential? We do this by getting ahead of the latest trends. We talk regularly with all the biggest funds and industry insiders to understand what verticals and concepts are gaining momentum in the short to medium term. We're constantly speaking at major events and always looking to get ahead of the latest trends. We need to be able to identify short and medium-term industry trends before they become mainstream. Then we want to figure out which projects are perfectly positioned to capitalize on these trends before demand picks up. Of course, they still need to have strong fundamentals and be able to pass the 7 tenets of our evaluation framework. But these projects have potential for bigger profits, and we thought this would be really valuable insights for our subscribers. So this is why we decided to create our premium research product, SIMETRI. SIMETRI members will also get exclusive access to reports and evaluations on projects that we think are perfectly positioned to capitalize on emerging short to medium-term trends in the space, but ones that also have strong prospects in the long term. These coins have much lower valuations and much higher upside growth potential in the short and medium term. We've also partnered with all the biggest online crypto destinations so that everyone will eventually see our ratings. However, only SIMETRI members will have access to these reports, and they will see our ratings 2 weeks before the rest of the market sees it. Overall, our goal as a company is to help our members get over to the winning side of the information asymmetry phenomenon. We truly hope that this video will help you become a smarter and more profitable crypto investor.